Since ancient times, among traders, there has been a legend of the Holy Grail, a symbol of absolute prosperity. They say, whoever possesses it can achieve wealth overnight, holding a strategy with a perfect win rate. But the road to the Holy Grail was never easy. Many sacrificed their accounts, others were left with loss and doubt. And in the darkness, one question echoed through the market. Does the Holy Grail truly exist? There's no eternal Holy Grail in trading, but there are principles that endure, not perfection, but understanding the market. The technical analysis.
Welcome to the lesson of technical analysis. To get started, firstly, we have to understand what are key price levels. In technical analysis, key price levels are areas where the market tends to react, either pushing price higher or rejecting it lower. You can clearly see this on the chart. When price reaches a certain area and repeatedly moves up, that area acts as a base. The problem is not understanding what these levels do. The problem is that, on the same chart, you can draw too many of them. Some traders use diagonal lines while others focus on horizontal zones. So the real question becomes, which type level actually matters? From my experience, I prioritize horizontal price areas. Diagonal levels are still valid, but understanding why horizontal zones are more reliable will save you from many unnecessary losses. Stay until the end. The reason will become very clear. Before we continue, I'm going to quickly mention my trading community on Telegram. There are over 700 traders sharing market perspectives. If you are interested, the link is in the description. What makes a level strong? Most traders fail not because the level is wrong, but because they misread price action. A very common mistake is, when price touches a key area, you enter immediately and then the trade gets stopped out moments later. So what should you look for? When price reaches a ceiling and you see a long rejection wick, which usually signals strong selling pressure, but when price reaches the same area and wicks are short, candles are small, price hesitates instead of reacting, that's a warning sign. It often means the market is not respecting the area and a break becomes more likely. Instead of focusing only on wicks, look at the reaction candle as a whole. When price reaches a base and immediately reacts with a strong bullish candle, that tells you buyers are more stepping in decisively. If that reaction is also supported by a base with many wicks, the level becomes far more reliable. One of the most important signs to watch for is consolidation directly at the level. If price approaches a resistance and instead of rejecting, it starts moving sideways, this is not a place to rush into a trade. Very often, this behavior means selling pressure is being absorbed. The market is preparing for the continuation. Simply standing aside during these moments has saved me from many avoidable losses over the years. Now, let me explain why I focus on horizontal zones instead of diagonal lines. At the bottom of the chart, you see the volume, which are large participants, often called market makers. They manage position at the specific price levels. There's a simple principle. Where large positions are built, those areas tend to be defended. That's why you often notice repeated volumes buys at the same price ranges. Diagonal lines may still show reactions, but those reactions usually originate from horizontal liquidity zones before. That's where real interest is concentrated.